Okay, so how does your marginal tax rate affect your financial decisions? So, so, so decreasing your taxable income uh, saves you more in taxes. The more your marginal tax rate goes up. So, the higher your marginal tax rate, the greater the benefit to reducing your taxable income. So, this is why wealthy individuals, for instance, are some of the biggest buyers of municipal bonds because the benefits are the greatest to those in the highest tax brackets who face the highest marginal tax rates. So, so additional taxable income is going to cost you more as your marginal tax rate goes up. So the amount that you save um, or or added to your tax liability is equal to your marginal tax rate um, multiplied by the change in your taxable income. So it's as simple as that. As long as you don't change tax brackets, it's your marginal tax rate multiplied by that increase or decrease in um, taxes. So marginal versus average. So the we talked about marginal and average in the example that I worked in the previous lecture. But for some folks, your marginal tax rate can approach 40%. It's a little harder with the new tax law because um, they did lower the rates. But we have an example that we'll see in a little bit. So when you add in for some people that live in places where they pay state and local income taxes, and along with Social Security taxes, that effective marginal tax rate can approach 40%. Your average tax rate is lower. That's simply the portion of your total income paid in taxes. So that's simply your tax liability divided by your taxable income, which is the example we worked at the end of the last lecture. Um, concept check, the 4.1, distinguish between progressive and a regressive tax. Tax burden of a progressive tax increases as your income increases. So tax burden of a regressive tax decreases as your income increases. The example I gave of that was the Social Security portion of FICA that goes away if you reach $132,500 in income. The another example of that is sales tax. The reason being is the lower income individuals tend to uh, consume more of more of their income or use more of their income for consumption. So as a result, they purchase more items that are subjected to sales tax. So as a result, the average impact of that is greater on them than it is on somebody who's wealthy, who may be purchasing things that aren't necessarily taxable, or they may not if they don't spend all their money, so, or all their income in a given year. Um, what is the tax bracket or marginal tax rate, and how does it affect taxpayer? So the tax rate at which the last dollar or next dollar of ordinary income is taxed. So it if you reduce your taxes, it results in a reduced amount. If you increase your tax liability, it's going to increase your taxes. So, example of why some taxpayers have marginal tax rate as high as 40%. Most of the examples you're going to see are places along the East Coast, the Pennsylvania, New York, you know, you know Massachusetts, so forth. Some of those tax rates are very high. So, but example under the new tax law, Single person that and living in Pennsylvania with $100,000 of taxable income would face that 24% tax rate that we saw before. They would also pay 7.65% in FICA. There's a 3.07% state income tax and a 3.97% local income tax. So you add all those up, you get 38.72%. So the pretty hefty marginal tax rate. So eight steps involved in calculating your federal income taxes. Just to note here, this is there are actually only 7 steps now because the exemptions, which is the 5th step, have been eliminated. Uh, so, so, but we'll go through the 8 steps. Determine your total income. Report your gross income after subtracting exclusions. Subtract adjustments to income to arrive at your AGI or adjusted gross income. So decide whether you're going to use the standard deduction or the itemized. Again, the so 12,000 itemized. The standard deduction for a single person is 12,200 for what it was for 2019. It was 24,400 for married couples. So as I mentioned before, it's awfully hard to come up with enough to, for most people, enough itemized deductions to justify or justify itemizing. So, and then 5 was subtract personal exemptions, which was eliminated in 2018. And you determine your preliminary tax liability, subtract credits, and then calculate your balance due to the IRS or your refund.